What's going on, everyone? Welcome to the Geeky Investor, where stocks talk and we translate. Today, we're going to be discussing the stock market fully explained for beginners in the 2026 edition. So please stick till the end of the video because it's going to really help you build your wealth over time. And this is going to be a very nice summary for the stock market overall. If you like this video, please make sure you smash the like button so that we make this channel stronger. All right, so what are stocks? Basically, a stock here, I'm going to show the highlighter. So a stock represents a small slice of a company. So basically think of stocks like this nice pizza. Of course, it's not nice, but think of the stock market as a pizza. The company is the big pizza, and whatever you buy, whenever you buy a stock, you're buying a slice of this whole pizza. As this pizza is just so big, or this company is big, and when you're buying into the stock market, you're buying just a small slice or a share of this company. So if you own all of the outstanding shares of a company, you would own the entire company. So one slice of the pizza is one share or a specific amount of shares. And then the more slices you have or the more shares you have, the more you own the company. So stocks also give you a certain rights depending on the class of shares. There are certain classes of shares. We don't need to get into that, but that's, would help you with the voting rights for the company. So, sometimes the company would ask you if they want to invest into some other company, what things that they should do, what things that they should invest into, tap into their future projects and whatnot. So all of that because you're holding part of this pizza or part of the company. So what's going to happen is you are able to vote your shares. Now, where can you buy the stocks? And what are some examples of stocks? So stocks are just companies that are listed on the stock market exchange, which is basically a network of exchanges where investors buy and sell shares for publicly traded companies. And these include, of course, Apple, Microsoft, Amazon, Google, Tesla, Nvidia, AMD, and many other companies. And actually, a lot of the companies, especially the US companies, are listed in the stock market. So you can buy a certain share of them using these brokers. So what are brokers? Those brokers are just, think of them, as the middleman between you and, getting and owning the stock. This middleman or these brokers would have to be the ones that are trustworthy and have got approval from the government. So basically, let's see a few examples, a few good brokers that I can recommend for most people. So we can see Interactive Broker, we see TD Ameritrade, previously called, and now it's called Charles Schwab. And we've also got Robinhood for those who are recently starting the trading or the investing journey. So these three investing platforms or these three brokers, they provide you with the ability to buy into the stocks without any actual fees. So let's say, for example, a stock is worth $100. You can directly buy the stock through these brokers without paying any extra fees for these middlemen. So the stock is $100, you just buy $100 and you're done. You don't have to pay extra money for this middleman. So there are a few ways where you can, make money from the stock market. So there are two main ways that you can profit from a stock. There's price appreciation and there is a dividend payout. So for the price appreciation, let's say that, for example, you want to buy Apple stock. So here we type on Google just Apple stock. And as you can see here, we can see over the 5 years, let's say you bought Apple at $122 per share. And now your share price is sitting at 285. So you've profited from 125 to 285. So that's around 150 or 160 dollars gain per share. So if you have 10 shares, you have gained $160 multiplied by 10, which is $1,600 within 5 years. So that's a nice profit. So that's the main idea of profiting from shares. The share appreciation, whereby the stock was at a certain price, and now after some time it's at a different price. This difference is what you have gained or what you have lost. So another way that you can profit from the stocks is through something called a dividend payout. So basically what dividends are is that some companies share a portion of their profits. Let's say that the company is making $1 million quarterly, maybe they would give you 2%, 3%, 5%, and even sometimes more than that in certain companies of that profit for you directly to take it as a cash, or, you know, of course, deposited within your broker. So you have, if you want to go for a dividend investing, that's it. You have to pick strong, stable companies that often pay consistent dividends and even increase over time. And you can see here, for example, there's a website that's called Stock Analysis that I really like, and we can type in whatever company name that we want. So let's say here, just for an example's sake, Johnson & Johnson, all right? Everybody knows here Johnson & Johnson. We go for dividends, and then you can see here on the dividends, you have a 2.56% dividend yield. So that means that a company is, let's say, if it's making $100 million, is going to be paying out 2.5% of that 100 million profits for investors on an annually, and that is going to be distributed to investors on a quarterly basis. So every quarter you get this amount of percent, and then overall for the year you're going to get 2.56% of their profits. So currently, what the annual dividend is $5.2. So whenever you invest and buy one stock of Johnson & Johnson, you're going to get $5.2 if you keep holding the stock for a year, because, you know, you've invested and you paid for one share $200. 2.56% of that is 5.2%, and that's the dividend exact number that you're going to be taking after the end of the year. If you hold the stock for 3 months, at the end of these 3 months, you're going to get a quarter of that. Even if you buy the stock actually one day prior to distributing these dividends, you're going to get that value, okay? So there are other stuff here with the dividends, such as the payout ratio, such as the dividend growth and buyback yield, and these we can dedicate a video for them. If you want to do that, please comment in the comments down below that you like to know more about dividends. Now that's the second way that investors can profit from stocks. Now additionally, what are the stock strategies that most investors should be aware of? So for an average investor, there are actually three main approaches that one can do, and I personally would recommend the third approach, which is the safest and best with the usually the best results that are almost, we cannot really say guaranteed, but on the long term, studies have shown that, you know, long-term investing is the best one with outcomes and is the safest. So we have day trading, swing trading, and long-term investing. So day trading is the shortest, swing trading is the medium term strategy, and long term is, as the name suggests, it's long term. Usually it's more than 1 year, and I would personally think of it like 3 to 5 years, and sometimes even forward for 10 years or even more. So day trading is a full-time high-risk strategy that relies on short-term price movements and technical analysis. Positions are opened and closed within the same day, and that's why it's called day trading. As for the swing trading, you're kind of, you know, like taking a swing. So for example, usually at the end of the year, in December, a lot of companies, a lot of share prices increase, and that's been just historically what's happening. So what some people do is that they buy in December and they sell at the new year, and then at the beginning of the year, you know, when people are celebrating, some stocks tend to go down, or most stocks tend to go, actually some stocks tend to go down, and so, you know, kind of they are swing trading. So they buy in at the beginning of December, sell at the beginning of January. So that's called like a swing trading, where it is a medium-term strategy where positions are held for at least 1 day and up to several weeks to capture market swings. So for example, they expect, you know, that the federal tax rate is going to change in a certain way. So in that regard, because based on their expectations, they buy in a stock and then they sell it after some time. And then there is the long-term investing, which is the most important one, the safest one, and the best outcomes is buying stocks and holding them for years. What I think of it is 3 to 5 years at least, and then longer than that. The stock price and dividends are typically the things that you would profit from, as we just outlined right here. Long-term investing is historically the most reliable way to build wealth in the stock market. So we can see here How would you actually, before I show you that, here I'd like to tell you something is where do you learn about the stock market or the stocks themselves? You can of course use YouTube, like our channel here. You can see many other channels on YouTube. You can see Google. You can start searching things online. But what I'd like to show you is a very trustworthy source of explaining fully the stock and how you would approach it, is the 10K reports and the annual filings from the financial details found on the company's website or the IR website, this investors relations website. So as you can see here, if you open Google, you type in NVIDIA investors relations, you're gonna go to investors, and then you click on financial information and then the SEC filings. Within these SEC filings, you can search which year you want. Of course, you need the latest numbers so that you understand the company more deeply. And then you can go for these annual filings. This is the first file that you should look into, in my opinion, because it's the one that's going to explain most of the things for you for the company. So let's say you want to invest in NVIDIA. Before you do that, you have to understand what the company is, what they sell, what's their products, their services, their margins, if they are a good company, if they are growing, what's their plans in the future, and who are their competitors, are they strong or not, and all of this is listed, and the risks and whatnot are all listed within this 10K filing, which is an annual report that's shown and sent by the company. So if you click on any of those, as you can see here, you've opened this 10K filing, and as you can see, this file includes 130 pages, but in order for you to be an actual active long-term investor, you have to read at least, if not all of this file, at least most of this file, because it really includes almost all of the information that you really need to know. So as we can see here, NVIDIA, and you can scroll down and start understanding the different parts of the company. And it is actually divided into 4 parts. We can see part 1, part 2, part 3, and part 4. Part 1 includes the understanding of the business, the risk factors behind the stock. Part 2 includes the quantitative, including financial statements, so income statement, balance sheet, and cash flow statements. These are the really important ones that you have to keep your attention to, and these ones are updated on a quarterly basis. And then part 3, miscellaneous stuff like directors, the CEO, executives, corporate governance, and whatnot. And then part 4 is the summary. So that's something that you have to keep your eye on, and that's something that you have to understand and read before you invest in one company. So the 10K reports, you also have something called quarterly earnings calls. So every quarter, let's say, there's quarter 1, 2, 3, and 4 within a year, because a year is divided into 4 quarters. At the end of each quarter, a company would hold a publicly shown earnings call. Within this earnings call, usually the CEO and the CFO would talk to investors directly with a Q&A session and question and answer session at the end of the call, whereby investors would be able to interact with the company's management, and this way you can understand the company more deeply, and it is updated on a quarterly basis, which is going to help you for your long-term investment. And then you also have the trusted financial news, like our channel here, of course. And then you've got the CNBC, Seeking Alpha. I really like Seeking Alpha, although sometimes they don't have a lot of information available freely, but it is a really nice source that I recommend overall. You've got other books. For example, everybody here knows Warren Buffett. He is the most legendary long-term investor on earth that everybody knows of. Here, this is his most famous book. Actually, this book is not his book. Actually, it is the book that is written by his. So it is the book that's written by him with that is kind of taken from his mentor. So it's called The Intelligent Investor. This book, I've read it once, and I've actually read a couple of more times some parts of this book, because it really helps you understand deeply what value investing is. I really recommend this book. And then overall, you've got these things and reading online. Keeping yourself updated, these would give you a strong fundamental so that you can understand what a company is and how to approach it. And now moving on to how stocks are taxed. This is of course different from one country to the other, but overall I'm speaking for those in the US. if you are in the US, it depends on if you are a long-term investor, and what is the definition of long-term investing here is 1 year or longer. So if you're holding the stock for 1 year or more, you're going to be taxed at almost 15% for most people out there. Around 15% of your profits are going to be taxed. So that's a smaller number as compared to your regular income. For those who also invest in dividends, it's also taxed at almost 15%, which is the same as for long-term investing. And that's definitely better than the usual income. However, if you invest for a short term, your gains within the short term, i.e. below 1 year, they're going to be taxed at the ordinary income based on your income bracket. So it can be 20%, 25, 30, 35% in certain cases, as you all know. So, we can see here we can see here some people say that I don't have time, can I make money off the stock market without putting a lot of effort, a lot of time in that? And the answer is yes. There is something called passive investing. And passive investing is you're buying into an index fund, which is basically a basket of many stocks, and if it goes up or if it goes down, you go up and down with that. So this includes the retirement accounts like the 401k, and it includes many other things and indexes, like for example the S&P 500. We can see if you type in here S&P 500, you can see here this is the S&P 500, which includes the biggest 500 companies within the US that are publicly traded, and you can see how they have performed over time. So we can see here over the last 5 years how they have performed, and they have got an 84% increase in their stock price. Okay, so as for the active investing, you kind of pick individual stocks. You pick individual stocks based on your research, and this requires more time and more reading and more dedication. However, overall, this has a stronger return, and it's actually even more fun. Now, is it worth to invest all of your money at the beginning, or is it worth to invest smaller amount and one by one? Now, to answer you, before you even invest your actual money, you can trade on something called paper trading. So this paper trading is really nice. I really like it. And I advise all of you here, if you have not invested before, to go for paper trading. So what paper trading does is that essentially you're not buying using your real money. What you're doing is, kind of you're having like fake money or imaginary money, where you can buy and sell stocks and see how your money and your account and your portfolio have really done over time. I recommend you to do this for at least 6 months and then see how you are reacting to the news, the market when it's crashing. Let's say you put 10,000 into a stock, and when a stock news comes out, the stock goes down and your portfolio goes down to $9,000. So would you panic or would you not? What happens? What's your personality? How would you approach that? This is all going to help you when you do paper trading. It's as if you're simulating real money without any real deposits or real money involved. So this is one of the ways that you can do it using TradeView. I really highly recommend that. Now, what would you expect for the returns? I mean, as an investor, as a person, at the end, you're trying to make your money larger. You're trying to grow your money. So you, of course, want to have your money become bigger and bigger over time. Now, there's something really important I'd like to show you here, is that there's something called linear growth versus exponential growth. So linear growth is whereby you put $100, let's say every year you're gaining 10%. So at the end of the year, you're $110, second year, $120, third, $130, fourth, $140, $150, $160, etc. And as you can see here, it's just a linear growth, whereby, whereas the exponential growth is you start with 100, the next year it's 110, the next year is 10% of 110. So that's 121. You might think at the beginning, oh, come on, that's a very small number. It's nothing really significant. But over time, as you can see here, at the beginning, it's not significant. But then over time, as the time passes by, it goes exponential and it just explodes as the stock market is exploding over time. So here, as you can see, there is a website that I really like. It's called moneychimp.com, and I'm going to be zooming here. So let's say that the current principal amount that you put is, let's just say, for example, you put $10,000, and an annual addition, let's say on an annual basis, you save $1,000 that you put in the stock, and you're going to grow this for, let's say, 10 years, let's just for an example's sake, and you're gaining 10% annually for these stocks, which is usually the average. It's going to be different from, you know, one time to the other. We can dedicate a whole video for that, but just roughly speaking, 10%, you get $43,000 after 10 years of investing. So 10,000 and you invest 1,000 for 10 years, so that's a principal amount of 20,000, you know, over 10 years, but you get $43,000, and that's a nice addition. Now, what I'd like to show you here is, you know, this is 10 years. If I make it 20 years, what happens? I'd like to show you that, you know, you have to pay attention that 10 years is 43,000. 20 years is not the double of that. It's much, much greater than that because it's not linear, as I was saying. So as you can see here, 20%, it's $130,000. That's more than 3 to 4x with just 2x here, okay? So as you can see, over time, the larger it is, the stronger the returns are. If you see here 30 years, you can see instead of 130, you expect 260, you expect, let's say if we make it to 40 years, you expect it to be $260,000, but as you can see here, it's almost $1 million. So that's a really significant change. That's something that you have to keep in mind. You know, the stock market, you're gonna gain money exponentially over time. So that's something that you have to keep in your mind. The longer you invest, the more money you're gonna make if you're following the right strategy. And that is it for our video. If you've liked the video, please make sure that you smash the like button and share this with your friends so that the channel goes stronger. Thank you.